Thank you. No, thank you for having me. Um, so as I discussed with Jonathan before, I'm going to be presenting this paper, Inflation After the Iran War, which was written in during April and May. So keep that in mind. It will use data up until the end of May. Um, and it was written for the annual meeting of the Bank for International Settlements just 2 weeks ago or 3 weeks ago. And the goal was precisely to do something that, as an academic, you probably should never do, but it was a bold and maybe foolish endeavor, which is let's try to use some of the existing current models to make sense of a very pressing policy question. Um, and so, of course, that means with a proviso that this was at the end of May, and things happened since then. But as importantly, I think the goal for it is to really expose the extent to which a lot of the work of the last 2, 3 years, or at least some of the work of the last 2, 3 years, that try to make sense of the inflation increases following 2021, is this been really actual scientific progress? I mean, we've had a big inflation disaster in 21, 20 between 2021 and 24. Um, we spent, and some people even that I see here in the room have spent a considerable amount of energy trying to make sense of why did inflation go up? Why did it go down? What could we have done about it or not? And here we are just 5 years later, and here's another shock, very similar to the ones that we were studying past 2021. Did we actually make any progress in that? Did the theories that we developed in the last few years, are they useful to anticipate what's going on in the shock? Um, and why do I say this is a particularly pressing question and a test on many of the academics working on this area? Because the Iran war is a classic supply shock, and is a classic supply shock in some ways not all that different from the perspective of, say, the ECB or the Bank of England or the Fed, which are the three central banks I'm going to be focusing on. Um, in terms of just the evidence and what has been developed. Um, and we had another one when Russia invaded Ukraine in 2022. So we had a somewhat similar shock then. Of course, we had many other things going on back in 2021 and 22. But it does serve, since we developed quite a few theories influenced by that, it does seem like a useful exercise to try to apply them. On top of that, and part of the reason why I was asked to write this paper and or I chose to do so, was that roughly 7 months ago, I had written a paper, 12 months ago, really. I had written a survey of to what extent does expectations data helped us make sense of why inflation increased and fell in 2021, 24. Um, and so that was an assessment, much more of an easy one, a much more academic one of like at the end of this inflation spurge, how did expectations data, which was a type of data that I had worked on quite a bit during these years, how was it helpful to make sense of that episode? And so, as arranged with Jonathan, I'll present bits of that paper as well as we go along. Insofar as when I talk about expectations data, I'll show you some results from there in terms of more prospectively how it had made sense of the past, even as this particular paper is really about the present. So, with that longish introduction, um, there was very clearly, with the beginning of the war at the very end of February, a supply shock in the sense that we have a dramatic collapse in maritime traffic through the Strait of Hormuz, which is very important for global trade, as well as a clear, sharp rise in oil prices, which was expected to persist to a smaller or greater degree, but certainly elevated energy prices and oil prices for at least 6 months, which has turned out, if anything, to have been somewhat optimistic back at the beginning, since it seems like they will stay a little higher even longer, given what was going on. So this is a very clear supply shock, something that increases the costs of uh, some inputs that are important for production in many countries, um, and that therefore pushes both inflation up as well as output down. Question is, I'm going to focus entirely on inflation. How much does this lead to a direct impact on inflation? Meaning, there's an immediate impact on inflation insofar as, of course, if energy prices are part of the consumption basket and the producer basket, and you're going to have an increase in inflation from there. Having said that, as you see from this graph, that would have led to, by themselves, that simple direct impact, immediate impact, is an increase in somewhere, depending on how you measure it, 50 to 80% in one relatively narrow sector, which, given its weight on Leontief matrices, or even more appropriately, its DeMar weight, would lead to an increase in inflation of about 50, 60 basis points directly from there. So as of now, that would be just what it is, not a huge deal. But how much will this lead to transmission that is beyond the direct impact on oil prices towards an increase in other prices that not only is larger, but especially propagates over time? So let me separate that analysis into four parts. I think the first component of transmission and, or if you want, propagation, is the extent to which other prices, non-energy prices, if you want, core prices, sometimes called, do they go up as well? And by how much and for how long? And I think the important insight that economists have for long worked on in this area, and which is very much revived in the last few years, is that that transmission depends ultimately on the stickiness of prices. That other prices are adjusted infrequently in response to movements in shocks, as well as in a few of these energy prices. And if we understand that process of stickiness, as the name indicates, you understand exactly how much and for how long will overall inflation count. And now there's an identity that turns out to be useful, which is that, and this is an identity, it's an accounting identity, that inflation is always going to be in a world in which some prices adjust and some prices do not. At any point in time, inflation is always going to be the product of the share who firms that adjust times the average change in prices among those that adjust. That's just follows from inflation being a weighted average of the changes in prices of all the goods. Okay. And what I think we learned from 2002 is that up until 2020, and for the previous 10-ish, if not 20-ish years, the share of adjusters was remarkably stable in the data for the Euro area, the UK, the US. Again, these are going to be my focus, even though I'm happy to, especially in the Q&A later, to talk about other countries. And so most of the actual inflation had to do with what was the average adjustment of those that were adjusting. Okay. And this is what led to models like sticky information models or Calvo sticky price models and others who assumed this to be constant, rightly so, because this didn't move all that much over time over the previous 20 years. Really, what we need to understand was the mean adjustment, the mechanism behind strategic complementarities, marginal cost sensitivities, and others that led to a change in that. Okay? But what I think was very pressing in 2021 is that the share of adjusters really quite significantly increased. And as it increased, that brought to the fore models that sometimes go under the name as menu costs or simply just state-dependent adjustment costs, where the share of adjusters can change over time. And those models, no matter which variant of them you happen to like the most or the least, all have the following important feature, which is that they are what I'll call inaction models. There are models in which there is a gap between a firm's actual price and an ideal reset price to which the firm would change its price if it happened to be able to do so, namely if it was free to do so. If that gap is small, then the benefit of adjusting the price will likewise be small. And given a cost of adjusting, the firm will not want to adjust and therefore allow for that gap to emerge. But as that gap gets larger and large enough, then it is worth paying whatever cost of rationality, making plans, paying information, paying attention, such that the firm will then close that gap between the actual price and the reset price. And so the idea is that this price cap is really the key important ingredient of it. But it's just not the fact that there is a price cap, but where that price cap is tells you very valuable information for this transmission and propagation of a shock. Namely, That gap at any point in time will likely depend on idiosyncratic shocks that affect how each firm, where its price happens to be, and especially where its ideal price is, together with aggregate shocks that have shifted everyone towards wanting to adjust or not. And so we can think about there always being a distribution where some firm, either because it adjusted more recently or further away, either because it had some shocks that have increased in demand or a fall in demand for its particular good, they may be nearer to the right, if you want, or to the left when it comes to this price gap distribution. What that implies is that if we see that there's a lot of firms' gaps are piling near the left barrier, that is where for lots and lots of firms, their actual price is well below the ideal reset price, then what you would have is that these models will have inflation pressure. What does that mean? That means that lots of firms are just getting very near the point where they want to change their price, and that change is going to come with a price increase. Okay? We can say that that shows that there's an inflation pressure in the economy. Likewise, another insight is that if we have a large shock, as we had, say, in 2021-22, where inflation accelerates, we should observe that for lots of firms, they're all hitting one side of the distribution. All their gaps are becoming such that their actual price is well below where they want their reset price to be. And therefore, the variation of price changes should go down. It should go down because almost everyone is raising their price because of the aggregate shock, not a combination of rises and falls because of idiosyncratic components. If we look at the data, and this is UK micro price data, we see a very strong validation of these theories. And that's why I think these theories, we have to take them much more seriously today than we did 5 years ago. During COVID, a large shock, a large idiosyncratic shock that affects some firms wanted to raise prices, some cutting them. We saw an increase in the frequency of price adjustment, both for firms who then raise their price and firms that lower them. Whereas during the large aggregate shock of just high inflation, you saw a big increase in the share changing only on the upside. But clearly, red and blue, or an average of them, was not constant, and especially it moved just as if you want this identity would suggest that it does, with the extra twist of like idiosyncratic and ag components would change. The mean change went up as well. So as important as the mean is the frequency, and therefore the combination of these two. But notably, the standard deviation goes up during COVID. Some firms adjusting their price up, some down, exactly as you expect with idiosyncratic shocks. But during the large inflation, we see that among those firms adjusting, the variability of price adjustment declines very significantly. Why? Lots of firms are in the price cap distribution on one side, and they're just all raising their price by roughly the same amount. They're trying to keep up with inflation. And likewise, and perhaps more subtle but as important, the skewness of price changes goes down. Why? Because again, you have a lot of firms piling up, all increasing at roughly the rate of inflation or thereabouts. Unlike before, where you can think about it much more of a, with a skewness of zero, much more bell-shaped symmetric distribution, that the times of inflation adjustment come with a lot of that concentration. So I think it's a combination of these four figures and lots of versions of them and more sophisticated versions or not that tell you that we need to take these models very seriously. And as we take them seriously, we need to think about these inflation pressures and realizations following the Iran oil shock. Next, now that we've validated these theories, one of their important insights is that, well, if I want to understand the impact of a shock, I want to understand the extent to which we're at a point where that shock is going to lead to a lot of inflation. A lot of firms are adjusting return. One way to measure that, which the literature is focused on, is the slope of the Phillips curve. Now, if you look at the slope of the Phillips curve and within the most canonical Calvo type model, that Calvo model will say that, look, it depends essentially on the slope is going to be essentially proportional to the frequency of price adjustment. Okay, if you have a lot of price adjustment, then inflation is going to respond faster, output is going to respond less. And insofar as we say that frequency change, at each point in time, of course, in a cross-section, you can say, like in a Calvo model, we have a certain frequency, it just happens to change over time, and then microfund that or not is what we were doing it in the previous slide, will have a faster response or not. Here's the average frequency-based measure of the Phillips curve for the UK before 2020, and here's the one using just the last 24 months average. And what you see is that there's a slight increase in the slope of the Phillips curve, which would say that the transmission of the Iran shock to inflation now in the UK in this case, would be a little bit faster. That's what it means to have a Sleeper-Phillips curve. Why? You see in arguments, certainly of policymaker speeches, arguments along the lines that say, well, this is to be expected because having had a large period of very high inflation, you now have that there's scars from that high inflation. Agents no longer are updating their prices more often. They're more attentive because they just went through a period of very high inflation. Sounds plausible, although according to this, not hugely quantitatively. But the elements from this menu cost say that you have to adjust the frequency by a measure of the distribution, and the measure distribution of these inflation pressures or realization, as captured by the skewness, turns out to be in a very important paper and set of work by Francesco Lippi and Fernando Alvarez, that it's not just the frequency, but you have to justify the kurtosis, the distribution of price changes. And all the kurtosis of capturing is really, again, the mix of the skewness, standard deviation, intuition that I gave you earlier. If you do that, then you end up with a slope of the Phillips curve that, if anything, is a little bit lower. That is a flatter Phillips curve than we had before in 2018 and 19. So this would say, actually, if anything, inflation is going to move a little bit less than now, but not a big change. However, there are two problems with these measures. First problem is that slope of the Phillips curve is useful to assess the impact of a demand shock, but the supply curve is a supply shock, strictly speaking. It's still informative because the determinants of the propagation of a supply shock also depend on frequency and the distribution of price changes, but it's not quite just these very simple moments. Secondly, is that these are steady state results. In a steady state, either with fixed frequency or the steady state distribution of frequency of adjustment, these results will hold. But if you look at this, you might well say, well, is it clear that we've reached a new steady state even when it comes to these frequencies? Not clear at all. Luckily, recent work, and I'm here going to rely quite strongly on a paper by Miguel Bandera, Laura Castillo-Martinez, and Yifeng Wang, really goes to the heart of what I think one should look in these problems, which is what we want is the distribution of the price gaps. As I told you, that's really what drives the whole models, those price gap distributions. So why not just go and estimate those price gap distributions at a particular point in time? And here is their estimates of the distribution of the price gaps. This is just overall inflation, but these are the price gap distribution with its moments in the two different grays. And those distributions come up with actually fairly insightful results, namely, or at least passing some smell tests. If you look at April 2014, you see that the distribution of gaps is very skewed towards the right. There's a lot of very positive gaps. That means that for a lot of firms, they have their price above their desired price. And what did you see post 2014? A period of a lot of disinflation and even deflation. That's what the models predict, and that's what, as a validation of this price gap theory, this seems to work. Likewise, when you look at October 2021, you see quite a lot of mass on both the right and the left tail of the price gaps, and lo and behold, we have a symmetric response and we had that inflation, in 2021, because we had a lot of positive shocks in 21, we had an inflation acceleration. But a little more provocatively, what the series would say is that if in October 21, we had had a series of negative shocks on inflation, we actually would have seen as sharp as a fall in inflation as we saw a rise, because the distribution was very symmetric with a lot of thickness on both sides. Why? Because of the COVID, the pandemic. The pandemic had created a lot of mass on both the right and the left-hand side of the distribution. We turned out to have a bunch of shocks in 21, 22, including the Russian invasion of Ukraine, that pushed for a huge increase in inflation. But if we had had shocks on the other side, imagine central banks had hiked a lot more in 2021 than they did. Maybe actually we'd be looking at 22, 23 as the period of the Great Deflation. That's what this theory suggests. What about now? When you look now at the distribution, by now I mean January of 2026, just before the shock of the Iran war, you see that there's quite a bit relative to usual mass tilted to the left and a somewhat thinner right tail than what has been usual for the last 20 years. Okay, what that means is that with accumulation of mass on the left of the price distribution, we'd expect a positive shock to lead to a fast increase in inflation, but a negative shock to lead to not much. And so when you combine this and say what happens using some local projections, conditional on the January 2026 distribution, what will a shock of a 10% increase in oil prices do to inflation? You end up with a relatively quick 3 months, really, 3 to 6 months increase in inflation of about 30 to 40 basis points in response to this 10% increase, which is significantly more than usual. Given the size of the shocks, what this says, which is the size of the shock is roughly, if you do a simple average, roughly a 40-ish% increase in oil prices on average pre and post Iran conflict eruptor, we get that we would have right away this year, and a little bit only of an increase only next year, a 1.2 to 1.6 percentage point increases in inflation. So the model gives a very sharp answer to what that is. It's fast. It happens in the second half of 2026. It's happening now. Inflation is going to accelerate with a little bit of an extra kick by 2027, and it amounts to roughly 1.2 to 1.6. Okay. Interestingly, that theory, precisely because of the lack of mass on the left, it says that if we have a tightening of monetary policy, a tightening of monetary policy actually has a weaker impact than usual, precisely because there isn't much mass on the left. And so relative to the usual robust impact of an increase in monetary policy and inflation, it would be half as large as before, something that policymakers may want to take into account. But so the first answer is transmission of the energy shock to the other prices in the economy. Let's round this up to 1.5 percentage point increase. It will happen quickly. End of this year, beginning of next year, we'll have the impact of the iron shock on inflation. Is this a lot? Is this little? Depends on your tolerance for inflation, of course, and we'll talk a little bit more about that. But that's the first answer. Second part, transmission. First transmission is what happens to the prices. Second part, transmission is what sometimes is called a second round effect. And what's a second round effect is that having generated a 1.5% increase in inflation, does this now lead to price setters seeing that, expecting that high inflation, potentially expecting it to persist, and because of that, raising their prices today by even more? Not because just of the transmission I showed you earlier, on account of marginal cost and transmission of the model across different prices, but because I expect inflation to accelerate. Likewise, if workers see this 1.5% increase, start expecting it or even more, to what extent that leads to an increase in their demand for goods, because you start pushing to buy durable goods right away rather than later when they're going to be more expensive, and that pushing demand increases inflation. And on both firms and workers, that if we start expecting that high inflation and more, do we start accepting bargains for higher wages? That's a second round effect. That's the sense in which expectations amplify, give a second round impact, then turn the 1.5 even to even more. And here is where, and going back then to the other paper that I had promised Jonathan I would also talk about, expectations data were really quite invaluable in 21-24. I think what we learned in 2024, first of all, is that the household and firm expectations are as or more important than those of professionals, because they're the ones who really transmit these second round effects. And that it's important to look at the distribution, because in 2021, it was really this, when you look at the distribution, you saw a big increase in the tail, and therefore, which was reflected in skewness and standard deviation measures, that really got ahead and showed us that an inflation was coming, and this propagation was very much true, as turned out to be the case ex post. In turn, note that these expectations measure, as of the end of 2025, show some sense of anchoring. But instead of words, let me show you some pictures from before. Here is a very, very simple picture, but which people not following these things as closely as others, but this is a real-time picture, don't quite see how invaluable expectations were. This is 2021, the 12 months 2021, when we're trying to forecast what's going to happen in inflation. Inflation is starting to accelerate in a really big way towards the middle and beginning of the year. What I plotted for you here is inflation, in the thick blue, divided by the standard deviation of monthly inflation. Why? If you thought inflation was an IED process, this is the t-statistic on whether there's something strange going on. Again, it's inflation minus average inflation between 2010 and 2020 divided by standard deviation of inflation between 2010 and 2020. It's the t-stat for inflation. Is this inflation unusual? And, you know, if you look your two-value classic trade-off, you'd say, boy, this inflation is highly unusual. What's going on? And it kept on being unusual throughout the year, okay? Now, let's do the simplest, if you want, switchboard where lights go up in terms of different indicators. If you're sitting at the Bank of Israel or at, I guess this is for the US, so this would be at the Fed, for seeing, is there something strange going on? One thing is to look at activity measures, like is employment really out of hand in some ways? Well, yes, employment was out of hand, but really it was but that's because relative to again the average of what it was before. But that's of course because remember employment goes up to the pandemic. But if anything, during this period, even though that T stat is high, if anything, it's going somewhat it's going down. So you're finding, oh no, there's less and less pressure on inflation from the unemployment rate. If you look at real activity and you're more of a Phillips curve guy, if anything, this was really the wrong sign. Why? Because if anything, you had, well, real activity is depressed, therefore I shouldn't expect any inflation to be coming. And if you're someone that instead looks at the real interest rate, again, real interest rates seem to go in the wrong direction. So if you are staring only, if you're the guy at the Fed who all they do is look at measure of real activity, and there's 100 of them, and there's measures of the employment rate, and there's measures of financial markets, you would say, I don't think there's any inflation going on. But the guy who's looking at expectations of inflation, and here all I had was simply the mean of the Michigan survey, you right away, just as inflation starts looking unusual, that data started looking very unusual. And that's why even the most naive observers, and I was one of them in the first half of 2021, looking at the expectations data alone said, boys, there's something here going wrong. Inflation is about, this unusual inflation is unusual in the second round effect, therefore it's going to persist. This is persistent rather than transitory, because what's really flashing big red lights on the inflation is the expectations data. But let me do this more formally. Let me estimate Phillips curve with data only until 2020 or December 2019. In classic Phillips curve, let me do the simplest thing. This is a master's thesis level exercise, maybe even advanced undergraduate. Regress inflation on expected inflation, remember both the first moment and the second moment, mean and standard deviation. Regress it on the labor market, regress it on the energy price index, PCE energy price index, okay? Estimate this between 2000 and 2020, and literally just ask that model to predict 21, 22, 23 out of sample, okay? How does that model do? And this is really, to me, as the Phillips Chair Professor at LSE, it's always hard being a Phillips Chair Professor because you know the Phillips curve, whenever we have a big inflation, it collapses, it shifts. So it turns out not to be the most useful model. This is the first time, I think, in 40 years where the Phillips curve in the US worked beautifully. If you just plotted inflation with predicted inflation by a model, and again, I'm not cheating, it's a model before 2020, it actually explained everything. And what bit of it explained it? If you split into the predicted from this bit, and this bit, it was the expected inflation. Indeed, if you look at the forecasting performance in terms of root mean squared errors, once you put an expectation variable, the Phillips curve, and especially if you do real-time data, this would be with the revised data, but let's focus on the real-time data since that's the one I have here. As long as you put some expectations measures, you were able to explain it quite a lot. And importantly, once you did that, including lots of things that people have done in the Phillips curve space, tightness as opposed to unemployment, so VU ratios, vacancy and employment ratios, kinks in the Phillips curve, lots of fancy global supply pressure indicators and others, they actually do almost nothing. What really matters was that you had an expectations variable. Once you had an expectations variable, you were in business. You immediately were able to explain everything that was going on between 21 and 24 in this very Phillips curve sense, even though I'm keeping fixed coefficients. So this is what I mean by expectations there were invaluable in real time as a flashing indicator, as a Phillips curve as well. But I also noted here that what about in 2025? What happens as I was writing at the middle of 2025? Are expectations anchored in the sense of, are they going to shift a lot? Are we going to see something similar during the Iran war? And here there was a result that was sobering, which is on the one hand, if you look at expected inflation, if you look at the standard deviation of inflation expectations, they all look back at normal, back in 2019, 18, 17 levels. But when you regress the updating of expected inflation between two periods, so when you ask someone H periods ago, and I said H 6 months ago, and now, so how much did Ricardo update his expected inflation? And you regress that on what was the inflation surprise in the 6 months. So again, so you're asking me today, Ricardo, how did you revise your inflation about 6 months ago? How much of that is explained by how much actual inflation we saw in the last 6 months? And then let's add some fixed effects for time, horizon, and me. This beta should really be zero. The fact that inflation turned out to be a little bit higher now should not affect what I expect inflation to be in a bunch of periods ahead. Okay, I should just think, well, essentially the current shocks don't lead to propagation, amplification, don't lead to second round effects, because current inflation doesn't lead me to revise what I think inflation is going to be. And let's do this for a long run forecast. So let's do this for 10 years ahead, 5 years ahead, using the US data and the Euro area data. And what was a little striking is that if you did this exercise before the great inflation, okay, you'd end up with forecast errors of, depending on how you write it, the different columns are just different fixed effect coefficients. But you get like a 1% more inflation led to an increase in 2 basis points, not a lot, even if significant. But if you look at after, run the same regression on the data of the last 4 years, these coefficients have increased by a factor of 4, which says that expectations are much less anchored in this very crude sense. In the euro area, this was especially true. We now have that a 1% higher inflation leads to an expected inflation jumping right away by 10 basis points, a relatively significant amount. And so that leads you to worry, well, really, this is going to amplify or propagate the shock when it comes along. So this is where we were before in the 21-24. What happened in the data? What happened in data is a great validation of these series in a sense, just like with the sticky price stuff. Why? Look at December and February and what happened in March. The euro area distribution of inflation expectations shifted to the right, even just as the Iran shock happened. Much more in the euro area than in the US at first, completely consistent with these estimates here. That is, the expectations shifted right away with Iran. People did not respond to the Iran shock. And they're talking about March. They're being asked like a few weeks after it happened, what do you expect inflation to be? Immediately start saying it's going to be higher. Okay? That's that an anchoring, and bigger in the euro area than the US. Give it a few more months. Let's go to May. I have the data for the US. For the euro area, we don't have the micro data, so I can only plot for you the 25th, the quantiles over here. And what you see is that in the euro area, there's a slight re-anchoring to the left of the median, if you want. But in the US, it shifted now to the right such that it matches the euro area. Namely, in both of them, the household data shows an increase in expected inflation of 0.7% on median, and especially, and a little more worrying, a thicker right tail in both of them, where the thicker right tail is precisely what we see in 2021. And so we are seeing second round effects. However, those second round effects and the extent to which this happened is much smaller than what we saw in 2021, 22 in a quantitative sense. So both the difference euro area US, second, the some shift, and third, the shift between the right tail confirms those theories and says that for the Iran conflict, we do have some second round effects propagation. You can do the same thing for the firms, okay? But now two questions, or one question, sorry, which is how much of this is due to the energy shock directly? Because remember, just as with the prices, we have a direct immediate impact that just the fact that energy shocks goes up does mean that you're expecting inflation should go up. If you want, that's the initial impact. Are people even just rational about it or not? And so here is some work, some regressions. Luckily, there's been, again, a series of work isolating the impact of the energy shocks alone. What I'm showing you here is from some work I have with a brilliant young economist called Paula Patzel, looking at how much does the increase in energy itself shift to high expected inflation. And interestingly, what you have is that direct impact alone is only roughly about 0.2. Remember, the total impact is like a 1.0, so 4 to 5 times bigger, although with quite a bit of heterogeneity. But importantly is that ratio turns out to be somewhat similar to 21 and 23. That is, that you have the same link between the direct impact and the impact overall. So as of now, the Iran war matches the theory predictions, or the predictions of the models of 21, 24 very nicely. And number two, it shows, yeah, we have some second round effects. We have a 1 percentage point of second round effects, say, on the mean. How much does this mean, though? Because I'm being very concrete here in this paper. How much does this mean for a second round effect on inflation? Well, again, a bunch of work, and I'm going to cite this one, although there's a couple of other related papers, show how much does an increase in expected inflation transmit causally to an increase in actual inflation. In other words, the second round effects. And the numbers in that literature turns out to be that roughly 1 percentage point increase in mean expected inflation comes with a 0.25 percentage point increase in actual inflation. So what's the size of the second round? Well, since we have a 1 to a 1.4 increase, that says a second round impact of 0.25 to 0.35. Remember, we already had a 1.3 to 1.6 from the first transmission propagation. Add up the two, we end up now with a prediction that inflation is going to go up by somewhere between 1.5 to 2.0 percentage points as a result of the Iran war. Okay, we had the first round effect, second round effect. What's the third round, if you want? The third round is policies. If policies feed even more inflation, we'll have even more inflation. We can then have endless debates on whether there was a propagation or a policy shock. But either way, we look back at 21, and the big discussion we have is the extent to which the fiscal stimulus of 2021 led to inflation being even higher than what the pandemic, Ukraine invasion, and so on other shocks would have done. Note that this does not mean that it's a bad idea to do fiscal expansion. Indeed, I myself have written that targeted fiscal expansions during times like the pandemic, even potentially during the Iran shock when it comes to the impact it has on the pocket of, say, the UK consumer, are probably a really good idea for welfare perspective. You're basically completing markets exposed, you're doing some redistribution that will be somewhat useful. Question, though, is that may come with some cost of inflation, and that's okay. In this paper, I'm not trying to judge whether that's a good or a bad idea. I want rather to assess to what extent there's an extra round of inflation on account of the fiscal policy measures that have been adopted in the last 3 months and then may be adopted in the next 6 months, okay, given the role that they have. Now, there's many fiscal policy measures. Of course, a very notable one that was announced here in the UK where I live exactly 3 hours ago, is, oh, why don't we cut VAT on energy prices? Well, yeah, if you cut VAT, that's going to lower inflation mechanically in terms of how we measure it. France did that notably in 2022. Those policies, let me just leave it as they have a mixed impact, mixed record, and I'll leave it at that. Happy to come back to it later. But I want to focus instead on a little more directly, a little more macro, the extent to which deficits and debts, the impact of Iran had on deficits and debts, to what extent that leads to more inflation. And so let me look at the past and the future. Let me start with debt and deficits. Here is a cool picture on the left that does the following. The best, I can't measure fiscal policy in real time in the last 3-4 months, or maybe, some people at the Bank of Israel can, but I don't have that capacity to be able to see how many fiscal measures, what's happening to deficits and debts. But luckily, the best forecasters of fiscal situation in the world publish their results. And who are the best forecasters of fiscal situation in the world? I'll argue is the Fiscal Affairs Department in the IMF. Their job is to track fiscal conditions, deficits, and debts all the time, try to come up with estimates of what's happening to those fiscal conditions at any point in time, and they update those every 6 months when it comes to the publication of the World Economic Outlook. So what I plotted for you here is how good they are insofar as in 2022, what was the revision of what they thought the debt would be at the end of 2023 during the WEO revision right after Russia invaded Ukraine and 6 months after Russia invaded Ukraine. And this is how much actually the debt increased relative to what was forecasted before. And the nice thing about it is that if you focus on the macro components, the nice thing about the WEO is that they forecast surpluses, interest rates, inflation, economic growth. So you can use the government's budget constraint to come up with their forecast for the debt. And what you see is that, yeah, those guys in Washington do a pretty good job. I mean, it turns out that right 2 weeks after in this case, 2 weeks after Ukraine, they update their forecast of the debt. These are for the different OECD countries. And their track record is pretty good in terms of, well, it depends. R squares of 0.45, slopes of 0.6. Sure, it's not 1, and the slope is not 1, but not a bad outcome at all. So what those same guys did in the April revision of the WEO, the World Economic Outlook, forecasted for debt and its 4 components. And again, the 4 components here are in red, the primary deficit, and in blue, inflation. They forecasted rightly that some countries, and they were right, Sweden did a lot of fiscal stimulus measures in the last few months. They have an election coming as well. Whereas some others, perhaps by far the most surprising, is France, which actually has implemented quite a bit of fiscal restraint over the last few months, and the IMF anticipated it back in April, okay? Importantly, though, for this paper is the blue line, which is the inflation. And the IMF is forecasting that the increase in inflation is going to be essentially zero, in that it may be positive in some countries, negative in others, because in different countries, they estimated the impact of the fiscal response or the inflation on the fiscal response to be positive and negative, depends here and there. So a little bit of revision up, but very modest on account of this. That's debt. And that is, if you're a fiscal theory of the price level kind of guy, that's the variable you care about as a fiscal. If instead of a fiscal theory of price level kind of guy, you're more of an ISLM kind of guy, to use 4 letters as well, you think it's not about the debt. Fiscal is all about the deficit. If you have a large deficit, that's going to push inflation up. That's the Keynesian channel, if you want, as opposed to the FTPL channel, linking fiscal policy to inflation. Here is the revisions of inflation of the IMF with the revisions of the primary deficit in 2022. And interestingly, this is basically capturing the IMF's internal model, not explicit, but implicit by how they revise their forecast, is that there is no relation between more deficits and high inflation. What about now? Exactly the same. The IMF is forecasting nothing. Question, though, is what happens ex post. And here's ex post now, 4 years later, what happened to inflation and the primary deficit. And there's a very strong positive relation. In other words, as of now, the IMF thinks no link between the fiscal response to the Iran conflict and inflation, but ex post, they were wrong, and maybe ex post, they're wrong again. But as of now, there's no conclusive link from the fiscal to the inflation transmission. And so we'll leave it at that. Fourth and finally, what is the ultimate transmission to an inflation shock is whether prolonged elevated inflation leads people to expect higher inflation, not in the next year, but rather forever. That you lose the inflation anchor. Because if everyone expects inflation to be 10% forever, then very powerfully, inflation will be 10% forever. A fundamental result, I think, in the study of inflation. Okay? How do we measure that? How do we measure that? If you want, this is the credibility of monetary policy. Did the credibility of monetary policy get lost after the invasion of Iran? The conflict of Iran, not invasion. Is inflation stuck at 2%? Did inflation in the very long run stuck at 2%? How can we measure that in the long run? Well, here the valuable data is financial prices. Why is the prices in financial markets useful? Because a few agents, namely pension funds and life insurers, do have very long-term commitments, namely in defined benefit plans to pay you a pension that moves up with your wages, nominal wages, and those move with inflation. And for those guys, this is a gigantic risk. If the inflation target goes from 2 to 4 to 5%, it will really bankrupt a pension fund. And so they buy insurance against that possibility. And they buy insurance in the form of swaps, in the form of inflation index bonds, in the form of options on those. And they feed a rich and liquid market where people are assessing that credibility and with real money on the line. So let's see what happened to that. So let's see what happened to the 10-year swap price around, this is the 10-year expected inflation, 10-year expected inflation, as of the gray line here is when the Iran conflict starts. If you looked at the raw data, that's the black line that you can download from any Bloomberg terminal or even Fred probably, what you'd have is that the 10-year expected inflation in the euro area jumped significantly by 20 basis points, but not at all in the US. Or 25 basis points, I think, and not at all in the US. That's a little surprising, because why would it be that the US is the more credible in euro area? Not. If anything, in the euro area, inflation is back at 2%, not in the US. If anything, the Maastricht Treaty would lead me to trust much more the inflation target in the ECB to be more persistent than the one at the Fed, which can be very easily changed by even just with a change in chairman. Well, in some work developed in the last few years, it's been noted that these prices are subject to a series of frictional components, different frictions of different kinds, that having to do with the fact that the dealers who sell these contracts are constrained in their ability to supply them, And the buyers of life insurance and pension funds are also constrained by a series of regulation. And you have to be very careful because these prices move around a lot in ways that probably reflect more frictions rather than a change in credibility. So here is instead focus in red at the estimates of clean from those frictions using recent methods, what expected inflation actually is. If you clean from those frictions, you end up that the increase in your inflation is around 0.1, 0.5, 0.2, 0.1 to 0.2, say. And in the US, it is roughly 0.1 to 0.5 as well. So that puzzle gets solved simply by using the recent research that has shown that you really need to adjust the black to blue. It turns out that the US had a lot of these liquidity friction shocks in the last few months, having to do with changes in regulation and just changes in what's happened to the US financial markets, which was not the case in the euro area, which had shocks in the other direction. So there was a massive overstatement of that difference. Instead, what the data says is that 0.15, 0.2 percentage points is the impact. Is that a lot or not? Is there a loss of credibility? Is the anchor lost? Well, let's do some simple mathematics. 1.5 from the first round effects, impact on inflation. 0.5 from the impact of expectations, second round. 0 impact from fiscal policy. That's the paper so far. That's these 48 minutes you've been listening to me. 2 percentage points over the next 2 years, cumulative. What's that over an average over the next 10 years? Well, 2 percentage points divided by 10 is 0.2. So this says that actually from 2028 onwards, 0 impact at all, and therefore no anchor at all. Loss, anchor is solid in its place. This data shows no loss of credibility. Let's dig a little deeper, because the loss of credibility is not just about the mean, but especially about the tails. So let's look in some work by a great Israeli economist, Alon Raviv, who's done this work on, let's use it, options to try and back out not the mean, but rather the tails of the distribution. So these are using swaptions. These are options on these swaps, trying to figure out what's the probability of different inflation outcomes at that 10-year horizon. And what I did for you here is doing every week in blue what happened in the 4 weeks before Iran, and in red what's happened in the weeks after that, both for the euro area and the US. Okay? First of all, you say, but in the euro area, there's been a much bigger shift than in the US. No, remember, and this, the Raviv et al. Work doesn't inform, the mean of these, by definition, is anchored by the swap rate. But that means that if you clean by the frictions in exactly the same way the swap rate should have done, you note that the euro area distribution should be shifted to the left and the US ones to the right. And once you do those shifts, that shifted mean is actually exactly the same in both of them. So there's actually no change in the euro area and the US. The difference you see here is entirely the frictions that we just cleaned in the previous slide. What's relevant rather is what happens to the right tail of the distribution. And for that, the US, by exactly shifting the mean, shows you what's happening. And the answer is nothing is happening. There's really no thickening of the tails. That is, you don't see these life insurance pension funds after Iran saying, I just think there's this tail event, this 5% probability event that inflation is going to go crazy. We're going to abandon the inflation target. It's going to be 5% or more. There's no evidence of that in the data whatsoever. There's no thickening of the right tail distribution. Guys, this is very different from 2021. In 2021, this clean 10-year swap increased by 100 basis points. 100 basis points, not 20, 100 basis points. And it clearly was moving up and down whenever you had these lines, different monetary shocks and fiscal shocks. Likewise, if you look at the probability of those tail distributions, there was a huge shift where the probability of an inflation disaster went from 1% to 4% and 1% to 3% in the euro area throughout this period. So huge shifts in these tails, huge thickening of the tail. There was really a loss of credibility that persists till today, the less anchoring. These tails are elevated. But following Iran, we just don't see an extra level of that anchoring here. So let me conclude in my last 6 minutes. Okay, what have I tried to do in this paper? I used developments in sticky price models, developments in how expectations propagate that, developments in how much fiscal policy shock can come with higher inflation either through deficits or debts, and develops on how to measure the loss of the inflation anchor and try to quantify so that it doesn't just become a 1-0, it's lost, it's not lost. I showed you that each of these was valuable in 21, 22 and explained some of the slight loss of anchor and re-anchoring, the connection between fiscal policy and inflation, the way in which there was a clear second round impact through the tails, and the way in which the distribution of price changes really tracked what these models predicted. And I tried to apply it to the data between March and May of 2026, that is, the last few months. And using those validated models with the actual numbers, I came up with the following pretty sharp conclusions that say that the Iran conflict is going to add 1.2 to 1.6 percentage points to inflation in the US, the euro area, and the UK in 26-27. The second round impact through expected inflation adds another 0.3 to 0.4. Fiscal policy, as of now, nothing. But let's see. Again, as of this morning, all of a sudden the UK is doing fiscal stimulus. Let's see what happens. Let's see as French elections get nearer and others. But as of now, no guarded grounds for optimism. And on the anchor, really zero an anchoring at all. We just see no change in the credibility of the ECB or the Fed, as I showed you. And if anything, very consistent impact on the financial prices of the adding up here of 1.5 to 2. Should monetary policy look through the shock or not, therefore? So I've now gone all the way and said it's 2 percentage points increase in inflation. But a question that policymakers ask is, to us academics and here central bankers as well, in the sense of the research central bankers, but I mean the central bankers being the bosses, yeah, should I hike interest rates or not? Should I look through this Iran shock or not? Okay. Now, there's a big change certainly in the way this thing is discussed today relative to 2021. Back in 2019-20, if I came to you and said, hey, there's some supply shock because of something in the Middle East, inflation is going to go up by 1.5 percentage points in the next 12, 18 months. What should I do? I think there was a majority of central bankers that would say, do nothing. Do nothing, see through it. What's 1.52 percentage points? That's not a lot. It's going to be pretty temporary, what you said. Me trying to hike with long and variable lags probably is going to be more hurtful than not. Today, and I submit as evidence the ECB review of a year ago, the answer has changed a lot. Why? Because the trauma of 21, 22, 23, when the thing persisted more, means that now central banks will say, no, we want to make sure that we don't get caught. We want to raise interest rates somewhat, if anything, aggressively to make sure that there's no propagation, okay? What has my data, these estimates shown? They've shown that on the one hand, there is 1.5 to 2% increase in inflation, not for 6 months, but for 18 months. That does merit some monetary policy response. On the other hand, there's really no support for a 2022 type hiking in 50 basis point steps for several times in a row, accumulating to a huge increase of 3-4 percentage points hike in interest rates. So as many economists end up with the one hand on the other hand, not touching interest rates, as for instance the Fed or the Bank of England have done so far, does not seem quite, maybe shows quite a bit of dovishness relative to the 2 percentage point increase. Saying we're going to be hiking by more than 1 percentage point, say, seems like a lot of hawkishness given the size of these numbers. But ultimately, what you do depends, and that's the way I put it, on how hawkish and how dovish you are. And here, I'll end up with my last picture, a picture again from my previous paper, from the one I wrote a year ago, on what those policy sizes are. Ultimately, policymakers reveal to us their policy choices, meaning their hawkishness and their dovishness. Because when you look at what does a central bank expect inflation to be, and what does it expect unemployment to be, well, under a supply shock, we have this extremely strong result from monetary theory. That's not just monetary theory, but captures the way central banks, at least, are supposed to think, and the way they often think, which is, given a supply shock, I will tolerate some inflation above target insofar as I have some unemployment above target. I do not want to be an inflation nutter, famously labeled by Mervyn King, in the sense of someone that has a lambda of infinity that says that, look, even if unemployment is a little bit above inflation, I want unemployment is a little bit above the natural rate. I want infinite inflation to stop that. Oh, sorry, it's the other way around. Lambda is a super dove, sorry, versus also whether how much inflation versus an employment trade-off are you willing to tolerate? Okay. And here is a picture that to me is very striking of the 21-24 debate, is that this is just a plot of expected inflation by the policymakers in survey economic projections versus expected unemployment. Is that whereas we used to have a positive slope, meaning that whenever policymakers expected employment to be high, they expect inflation to be high, that is, they thought, look, I'm trading off the two. In 21-24, they expected employment to be low and inflation to be high, and yet they didn't hike. That is a violation of just basic optimality. The fact that you have a negative slope here rather than a positive slope is a clear violation of optimality. And that is a sense in which we saw that some of the inflation disaster of 22 was a policy choice, because those policymakers were expecting high inflation, expecting low unemployment, and didn't hike, or didn't hike as much as that would merit. Likewise, now when we ask how much inflation is going to be, we have to answer with last part is, are policymakers going to hike, cut, or keep interest rates unchanged? And I think the big question is that the extent to which they see this 2 percentage point predicted in this paper and respond to it by combining that with an employment forecast, that leads them to either hike or cut interest rates in that. And if they cut, and it turns out at the same time they actually don't expect much of a recession, then the 2% can become 4, 6, or 8, as we saw in 22, or not. But ultimately, even as I went through without mentioning monetary policy a single time through the whole paper, I need to spend the last 5 minutes talking about monetary policy, because ultimately inflation is whatever monetary policy does in response to all these shocks. The shock may be 2 percentage points, but ultimately is whether monetary policy chooses to turn 2 into 4 or to turn 2 into 0. And when it chooses to do so, noting that, for instance, if it goes from 2 to 0, that may be at a big unemployment recession, which may be undesirable. But likewise, it could also be in the other direction. And that's all I had, and I'm 10 seconds early, so I'll stop here.
Excellent. Thank you very much, Ricardo, for a presentation that I can qualify as very captivating. So we will take questions. Please raise your hand if you have any questions. So we will start with Eran Yashiv for the first question.
Thanks, Jonathan. Hi, Ricardo. Nice to see you also this way. Great talk, as usual. My question is on the last few slides. If people, remembering all these Krugman, Summers, and others debates back then, if they were doing what you've just presented, the kind of analysis, especially statistical analysis back then, with the data they had back then, would there be, you think, fewer policy mistakes? Is it a question of not the correct analysis being done in real time?
I mean, I wouldn't go as far as saying correct or incorrect analysis. I think that's a little bit too strong in terms of the words used. Certainly, Iran, but that's a very, very good question. So I'll disagree with the use of correct, incorrect. I think that's a little bit too harsh, or maybe I'm just more shy than you are. But on the substance of your question, 100%, and that's a great question, because it's really what I tried to do in this last hour and in these paper, right? What I was asking is, I wasn't getting into the debate of policy right or wrong, but rather, there's been a lot of work in the last 3, 4 years. I did some, and certainly in this presentation, I abused or was biased towards some of the papers I wrote, but really a lot of people have written papers. I'm a very small contributor to that literature. And those papers have really changed, I think, our views of how to model first round effects through the developments in sticky price models, how the modern ones are, the measurement of price gaps, which is really a fantastic set of work. And there's work here, by the way, I use the work of Bandera, Castel Martin, and Wang, but there's incredible work by, just at the Summer Institute last week, Gagliardoni and Gertler and company, great work by Alvarez and Lippi, as you'd expect, great work by Isaac Bailey, many others working on that. And what I showed is that with the tools that we have now, that we did not have in 2021, I can kind of say, well, this is going to be a pretty quick transmission, but at the same time limited quantitatively, and those tools didn't exist then. And I then did the cheat of saying, oh, but if I used them then, I would have also seen how much we're going to get an explosion in inflation. But we didn't have those tools then. Or we did and we didn't. I mean, we can say how much, or at least we weren't paying as much attention. Likewise, on the expectations. On the expectations, as here I was a little more critical around, because I showed you that if you were looking even in real time at the data, boy, you should have seen that there was going to be a lot of propagation. So here I will be a little more critical of not using the right tools. And I think certainly if you look at the analysis of some of the people that you mentioned and others, they really don't use the expectations data, which in my view they should. And I think that was a failure then, and still a failure that persists in some of those analyses. But beyond that, we have also better measures now, a better understanding of how to measure an anchoring, how to look at second moments, how to quantify them, how to go from those moments into an increase in inflation. And so I could give a much sharper answer here in terms of this. Back then, let's put it this way, in 2021, I think there was enough, and there were quite a few people, or some people, saying, boy, there's a lot of inflation coming because of the second round effect, but we couldn't quantify really how much. And now I think I'm much more confident quantifying how much today, okay? On the fiscal policy, here may be less progress insofar as I think the experience of the last few years let us rehabilitate the importance of fiscal policy for inflation. But I think what I showed you is that at least looking at some of the real-time data, it continues to be very hard to link fiscal policy to inflation. And that's why I end up with an inconclusive. So a lot of fantastic work here. People like Francesco Bianchi, Leonardo Melosi, and many others. Is that work to the point where in real time I can say we're going to get a lot of inflation next year on account of the succeeding fiscal impulse? Not quite there. Not quite there. Partly not because of the fall of the models, but partly because it's just so hard to understand what policymakers are going to do in the next 6 months around. And so we just don't know. Finally, on the anchor, I would say this is where we have the strongest progress. I think back in 2021, there was no work on swaptions. Nobody had written a paper using the swaptions in the way that was done there. The 10-year swap prices, full of noise. There was no attempt at cleaning them. In fact, a lot of policymakers rightly neglected the raw data from there because they say, look, this 10-year expected inflation moves by 10 basis points every day. That has to be wrong. My credibility didn't change by that much on a daily basis. And so that data was dismissed, both the swaps, the swaptions. Here, a huge amount of work that has made that data, I think, usable. And I even know, I mean, there was even some links here to some data repositories now, so that now in real time you can go and pretty much download those kinds of data. And that data gives very sharp answers in 21, 22 on how much an anchoring there was and re-anchoring. It's amazing around how it unanchored with the inflation shock and with the policymakers and the whole transitory. And as soon as they start anchoring, within a few months it re-anchors. It's clear that the insurance and the pension funds, what their judgment was on all that talk about transitory persistent, on actually hiking rates versus just giving speeches. It's just striking. Financial markets are ruthless, if you want, at showing you this. And on this also, here the answer is the one that's the sharpest of these four answers. There's just no change in the anchor here. It's just incredibly clear numerically and how precise it is. So that's, I think, sorry, a somewhat longish answer, but like the extent to which I think there has been progress. And the point of this paper, more than revisiting old debates, is to show the progress that we've made and how we can give. I at least think that the fact that I was even able to write this paper, the fact that I can show to you with a number here and not feel completely embarrassed, ashamed, afraid, as usually I would be in trying to make forecasts, is, I think, a great sign of a lot of that progress.
Thanks, Ricardo.
Thank you, Aran, for your question, and Ricardo for your replies. So we have another question from Amit Friedman.
Thank you. Thank you very much for the interesting paper. Very timely, just hot from the oven, I guess. One point about, a general point about the measurement and treatment of oil prices. I would say that when it comes to oil, using the spot, or the more accurately the front month Brent and so on, it's not enough. You need to have a look at the whole forward curve because it reflects the expectations of the market. it feeds back into the expected inflation. Now, when I look at the curve right now, the spot or the C, what's called the front month Brent is traded at 91, and the forward curve has a strong so-called backwardation, so it drops sharply to about $70 by the end of 2027. So in other words, the market expects prices to decline and to have a negative impact now on inflation going forward. Now, throughout this conflict, this has been the market's expectation, that this is a very transitory shock. Prices are going to fall very strongly once at some point of time, hopefully this would go away. So just about this point. Thank you.
Okay, so three answers or three comments on what you said. So first of all, I started the talk by saying, well, when I look at a picture like this, just like you did, but using just the one that's already a little old, by the way, this is already, again, a month and a half old. I said, well, if I put some numbers into this, this would lead to roughly a 30 basis point increase in inflation. Okay, this is using the spot for into the models. Note that that is not part of the paper, and that's not part of the paper, that sentence I just made, exactly because this is the part where I'm least of an expert in, and I understand less exactly how to translate that. If I literally just feed in the spot prices and calculate Omar weights, I get 20, 30 basis points. But that is, I don't know how to read this as all that accurately. And you already went deeper than what I would have been able to do. Okay. Because of that, I didn't use that. Then the entire rest of the paper is on all the other effects that go on. And so I never used this picture for any of the calculations that I made. So the first answer is everything that I told you does not use this at all. Just focus on the other impacts. I mean, if you want what I called, I'm going to look at the transmission propagation, not at the shock at all. So that's the first thing. Like, it doesn't really change anything that you've seen, just so that you understand that. Second comment, as you said. However, of course, that the way in which people perceive the shock is going to impact the expectations, the credibility, and the fiscal, especially the fiscal, in my view. And it's precisely the way these curves move and how we interpret them that I think is going to be extremely important for that inconclusive bit of what happens to the fiscal. Because the longer these oil prices stay, and I really want to trust these markets in trust, but with care, and the analysis that you just advanced in the last couple of minutes, to try and make sense of, is this going to be a persistent impact? That will affect all of my channels, obviously. Just, if the shock changes, you'd expect things to change. But I think on the fiscal side is where I think that's especially important. The fact that we've seen almost no fiscal response yet is because the impact on the spot, on the prices now, as transmitted to electricity and also the pump in a relatively modest way, partly having to do with this expectation it's going to be very temporary, according to the markets, and the fact that it's been summertime, spring and summertime. I think as the winter approaches, as we think that these prices are going to stay higher, the size of the shock is going to have to be revised upwards. As the size of the shock is revised upwards, obviously all the four transmissions that I said would be revised, and especially I think the fiscal becomes especially important. So that's the second comment. And then finally, a third comment, but that's a much easier one, as you said, is it's been quite striking to, and I have myself looked a lot at what's been happening to the oil prices. What I learned in the last 2 months, and again, not being an expert in this area, but what I've learned, and at least for other people here may find that useful as well, is that as important as the ships going through Hormuz is what happens to demand for imports of oil from China. It's just really remarkable, the decline in the imports of oil from China. I think if you do some simple calculations, if I instead of traffic, I put here how many barrels of oil go through Hormuz, more than half of that is offset by just a fall in imports of oil to China. Now, is that because the Chinese are using reserves to an incredible rate? Or is it because there's been a remarkable substitution in China from combustion engine to electric cars, like at a pace that's really remarkable? I mean, you look at some of the numbers, so what's happened to gas at the pump in China, as well just consumption of gasoline at the pump, for which we have data, as well as what seems like data on sales of electric vehicles. And it's really incredible. I mean, the elasticity substitution are things that I wouldn't have expected before. As for the reserves, there's a lot of uncertainty on whether they've used a lot of them, a little bit, or not, and others. But I would add as a third answer, or something that other people may find interesting, is that when I look at the data, what impressed me as much as what's going to happen to Hormuz and market expectations of forward refinery and others is really what's happening to demand from China and just how quickly in only a few months we've seen a massive elasticity of demand on that market. So I'll add that third point, which I think is an interesting one, at least some people.
Thank you very much for this reply and the question, Amit. So we have another question from Ariel Karlinski.
Hi, thanks. You mentioned in passing real-time data versus revised data. It's my understanding that unlike total non-farm employment and GDP growth, inflation is not, there's virtually no revisions in inflation publications by the BLS.
Okay, so I mentioned in the context here the Phillips curve. So this is where this was real time versus revised in these, it's really in these numbers as well as in these ones. But why do I mention that? Because here what I had was the Fed's forecast of inflation. So this is PCE inflation. PCE inflation is absolutely revised, like with any NEPA. The one that is not revised is CPI inflation, but this was regressions with PCE inflation. And so that does get revised, as does, as you mentioned, the labor market. The expectations data is not revised. The measure of the supply shocks, I mean, the PCE food price index, of course, is revised, but this global supply is not. So that's the sense in which there were some revisions because I was using the PCE deflator, the consumption deflator. That's that. Turns out it doesn't make a gigantic difference, actually. Well, the revised data, the model does a little bit worse, but not massively worse, by the way, in terms of the pictures. I mean, massively worse in the sense of twice worse in terms of root mean squared errors. But the ordering, which was my point, which is what really lowers the mean squared error, is adding the expectations variables. The other stuff, not so much. That's true in either of the two types of data.
Yeah. Can I have a follow-up on that?
Yeah, of course. Yeah.
Is there like I think it's the Philly Fed that has a real-time data set for microeconomists? Is there a similar thing for the PCE inflation?
Of course, yeah. This is using the Philly Fed, I mean, I think it's Philly Fed. I don't know. It's in Fred, or it's in Alfred. I think it's in Fred. You can just get the real-time NEPA data for all the GDP.
Both the real-time and the revised.
Yeah, of course. Yeah.
Okay.
This is standard Alfred Fred data. Nothing fancy here at all.
Cool. Thank you.
No problem.
Right. Thank you. So we have another question from Paolillo Aldo.
Hi, so thank you for your talk, and have a very brief question. So you have any evidence between the difference between a natural gas price shock and an oil price shock, because that may matter when you compare the 22 crisis to the 2026 one?
No, sorry, short answer. No, I don't. I mean, the results that I've shown you, or the analysis that I showed you, is not deep enough to make those distinctions. Note though, and at the risk of repeating myself, but that's okay. Repetition is how information transmits. You know, this is a little bit back to the previous answer on what happens to the oil forwards and on and so on. The analysis I used does not use directly what you think is going to happen to oil or gas or whatnot, right? All I looked at is what happens to costs of insuring against inflation, what's happened to deficits and debt, what's happened to expected inflation by households, what's happened to prices of non-core goods, okay? What are their dynamics? Where were they? Where do we expect them to be given a shock? The actual measured shocks is actually the actual measured data. Therefore, if you tell me it was more gas, more not, it wouldn't change anything in any of the slides that I showed you. Obviously, what it changes is the interpretation, and it changes in the answer to my previous question, which is that if then you tell the previous answer, which is if you then tell me, oh, Ricardo, but now I think that we're going to have an extra shock beyond the one we observed in March, April, and that's coming through oil instead of gas, so it's going to be more or less persistent, then all these responses may change. And that was the same answer I gave earlier. But so that's in terms of like what you saw. More generally, in the economic literature that I know, that I've read, do we have sharp estimates of the difference between an oil price shock and a natural gas price shock on, say, the expectations, or even on the price the second round? Not that I know of. I can think of one paper which I think has done a great effort, has made some progress, but I think maybe I'm being too modest, but I don't think we can really distinguish that all that well with the current state of knowledge.
Yeah, thank you. So my question was just because, I mean, these two sources may be moved by different fundamental forces, but
absolutely.
Thank you for your answer. Thank you.
Thank you, Paolillo. We have another question from Tomer Fergan.
Ricardo, great talk as always. Question about the uncertainty component. So with the Iran war, we basically have an experiment of a random number generator running geopolitics, if I'm being politically incorrect enough. If I see this as an agent in one of these fixed menu cost models, I say, okay, the option value of waiting is just fantastic. I don't know what's going to happen tomorrow. A miracle might happen. Peace might break. After all, there have been like 8 wars ended in like 8 weeks, according to some of Trump's statements. So how does this affect the pressure coming from the bottom that you mentioned? So,
good question. I mean, it's a great question because exactly you're pinpointing something that's very that's an important force in these inaction models or state-dependent models or many cost models, is that uncertainty should matter quite a lot for these adjustment to shocks, right? And so starting here of why would I think that adjustment is faster than before, which I mentioned. We don't trust the central bank. We don't trust monetary policy. We price setters, meaning, and therefore we're just adjusting prices much more often. We're paying a lot more attention, adjusting prices much more often. The filter is ever steeper. As you said, there's a countervailing effect, which is if we think that there's a lot more shocks coming from whatever source, at the same time we're paying more attention, but on the one hand, because we know more shocks are coming, we have this option value of wanting to delay things a little bit more. Usually in action models, the first effect beats the second. That is, yes, there's more option value, but you still observe faster reaction response to shocks because you're just updating more often. That is, it's true. You update more often, even if the option value means that, you have more, the expectation of higher variance means you adjust less often, but the actual higher variance means you update more often. And the latter effect ends up being bigger than the previous one in terms of perception versus the shock. So ex post, you observe a little bit more. I think that's so in theory, you kind of went to the heart of what I think is an important effect there. And part of the reason why when I was looking here, even in the steady states, you don't end up with a sharp answer there. Now, on option values and others, or with uncertainty more generally, I mean, it's a little bit tricky as follows, Tomer, because it's true that, and it applies in general to assessment of models with uncertainty shocks. It's true that if it's only about figuring out the level of where we want to go, uncertainty leads to delay. That's the option value result. But often forgotten is the fact that if the uncertainty is on the rewards to a technology, then actually you want to move faster. In nerdy terms, additive shocks, option value means wait. Multiplicative shocks, option value means don't wait, actually move faster than before. And I think that's a very important distinction when we try to apply these models. I think too often, because the option value result of delay is such a cool result that we like to teach as theorists, we kind of try to apply that one. But when we apply it to the world, and I'm never quite sure when you use these wonderful measures of uncertainty shocks that people like Scott Baker and others have produced, and it's often, well, that means delaying. Well, it depends a little bit. Is the uncertainty additive or multiplicative? And certainly those estimates are not clearly separated as two. And so on the example here of if you're saying it's just literally, I'm going to keep my technology the same, but now I'm going to have more of these energy price shocks coming much more often, then you'd have the delay effect. But if it instead involves, no, instead what it means is, I think that these high uncertainty on the oil side means that we're going to have a very fast development of technologies for electric vehicles or things of that type. Well, then maybe what I want is actually to update much faster and change that way. Let me, on top of that, then answer with a question on completely unrelated to the seminar, but I think it's a really fundamental question right now when we think about AI and the new technology, right? So there's a big new technology, Tomer. There's AI is arriving to economics, science, as well as to many other things. Should you sit still, not learn how to use Claude or ChatGPT because there's so much uncertainty how AI is going to be helpful or not, which is going to be the best model? Or should you start using it right away because you want to make sure that you understand how this thing works? Most economists I talk to are in the latter camp, which says that you think it's multiplicative. The uncertainty on AI is not leading you to not use it. It's leading you to experiment the new technology, the multiplicative, how productive it is, and to do it faster than usual. And I think beyond our little bubble of economics, also in the real world, we're seeing a lot of investment, which I think reflects that. So an uncertainty shock, and I think AI is a huge uncertainty shock. I mean, we don't know how it's going to work, is leading not to wait and see, quite on the contrary, into anticipating and rushing to use things. And I think that's I would like to make that contribution because often the uncertainty debate is all about delay results, but actually the theory is very clear. You don't, if it's multiplicative, you don't delay, you actually anticipate. And I think, and I see that in my friends around me, and I think I see that in the economy as well.
Thank you very much for your replies and Tomer for your question. And we have another question from Lassen Bunader.
Thanks, Ricardo, for this great talk. So I have a question regarding your final verdict on the inflation anchor. So how should we read the results of the regression where you regress the revision of the expectations with respect to because as you said, like the coefficients went like 4 times compared to the previous period. So how should we read this result?
Sure, very well. So these are, let me elaborate a little bit on what's plotted here. What I showed you here was an in-between, which was professional forecasters, 5-year ahead expectations, or again, long-run forecasts, 10-year ahead, sorry, for the US, 5-year, but of the professional forecasters, okay? So this is the revision of the guys being asked by the survey professional forecasters in the US and the ECB, the 2 surveys, of how do they update their forecast. So it was a subjective one. It was a survey answer, not a financial market, and it was at this long horizon in that sense, okay? And so what I showed here is that the professional forecasters are more jittery than they were before. That's basically the way to say it, which is to say that when inflation is high because of Iran in the last 3 months, 6 months, what I observe is that the professional forecasters are changing what they think inflation is going to be in 2036, okay, or average between now and 2036, okay? Note, this is a little bit of an in-between, right? Because on the one hand, these are surveys and they're households, and it's capturing a little bit of, or households, I mean, they're professional, but they're still households, and the financial market one, okay? And this showing there's a little bit potentially of more of, I did not update this or saw what happened in the last 6 months, right? What I did was instead say, no, I'm going to look at the markets, and I saw 0, no response, de facto, no response. And look at the expectations of the households, where I saw a 1 percentage point response, roughly, if you want to average what I have here, right? I have not looked at that in between, okay? Why? I didn't feel like I needed to, because the markets are just so sharp in showing nothing right now. If there was more of a gray line, I would have gone and looked at what's happening to the professional forecasts in the light of that regression or not. Since it wasn't, I didn't feel the need to. Yeah, so that's basically the answer to that.
Thank you very much, Lassen, for your question, and Ricardo for your reply. So we have 4 to 5 minutes. If you have one question in the audience, feel free to raise your hand. So I have one small, maybe 2 small questions, maybe stupid, but I want to ask them. So the first one is, I did not hear during your presentation a lot talking about exchange rate. What happened in Israel, for instance, is when the oil prices increased, then the exchange rate decreased in the sense that the shekel strengthened. And then it allowed us to pay less oil, and maybe the transmission, maybe, I mean, of course, it's not my field, so I'm saying maybe stupidities, but it allowed us to pay less this increase of oil prices. And I did not hear in your presentation how this interact with all the components of your model, from the prices to expectations, and of course, fiscal policy. So do you think exchange rate plays a role, and if yes, how?
Very good. So the reason why I did not talk about exchange rates to a first approximation is that, again, with my limited resources, I was applying this to Euro area, US, UK. And in these economies, they're not small open economies, either of them, and therefore the exchange rate channel is not quite as important as some of the others for me to assess. As I said somewhat jokingly when I presented this at the BIS annual meeting 2 weeks ago, and I remember because your own governor was in the front row at the Bank of Israel. I'm kind of trying here to do the job that a chief economist should be doing in terms of trying to answer how much inflation is going to be. But I have a staff of 2 people, two of my lovely research assistants who have been working with me for 2 days. I don't have 100 people or 200 like the Fed. Between the Fed, ECB, and the Bank of England, there's 500 PhD economists who can help them do this type of exercise. And so my ability to do this for many more countries, look at the data, dig the data, understand the data, clean the data, apply to each country is just limited. So that's the bad answer, which is I just don't have the capacity to do other countries, and therefore exchanges are not the most important. Second, though, and again, still within at least just those countries that I know better, exchange rate channels, say in the Euro area versus the US. Jonathan, the first order thing is that the supply shock, the increase in oil prices raises marginal costs everywhere. However, depending on whether you're an oil producer or consumer, exporter or importer, this is either a positive or a negative terms of trade shock for you, right? And so if you think that in Europe, to take one extreme or one example, this shock means that Europeans are poorer, then that loss in wealth should lead to a reduction in consumption, which would therefore attenuate the impact on inflation. Whereas in the US, as an oil exporter who's now richer, whose consumers now want to consume more because they can sell their oil for more, that will lead to push upwards of inflation. And therefore, to my forecast, to my estimates, you'd get a plus considering the exchange rate on the US number and a minus on the ECB number. Now, the work that I have seen looking at this channel, and especially given how the exchange rates did not move all that much quantitatively, so we can look at just how much did the exchange rate move right after Iran and before, even though they move more or less in the right direction for the channel I told you, quantitatively that effect is pretty second order. So it would really change the numbers by maybe 10 basis points up and down, maybe a little bit more, but not a huge amount. And so it turns out that exchange rate channel, while qualitatively it's absolutely there, while it's definitely worth studying, while for small open economies may be much, much bigger, for the numbers I showed you, I don't think prior it would matter too much. And I already qualify that prior in that it may be a lazy prior in that I wouldn't be able to do it anyway. So maybe I've convinced myself it wouldn't matter too much. So I don't have to do it. But yeah, but I don't think it would matter too much.
Okay. No, I understand. But I mean, in Israel, you need, since a year, if not more, we see this strengthening of shekel. And that's why I asked this question. Absolutely. It's more a medium or long run question, of course, than a short run.
But even the short run, it matters. In the short run, a big change in exchange rate can really
but of course less. No, but that's good that you are talking about that, because it's related to my second question. So when you say that we have this pass-through of 1.2 and 1.6 percentage point, so, and you cited this very interesting paper. So in parallel of these estimations you made, you cited this very interesting paper by Gertler on micro and macro cost prices.
Yeah.
And in this paper, they said that so there is a state dependence, but also the pass-through is the non-linear and varies with the size and the nature of the shock. And I did not see this I did not see this differentiation in your paper and the model.
Very good. So on the type of the shock, there was here where I showed you that the impulse responses to a monetary policy shock versus an oil price shock, it makes a big difference which one it is. And notice how here the sign mattered. That's what I emphasize. I should have emphasized more that it's not just the fact that one is positive, one is negative, but also that there are different types of shocks and you get different impulse responses to one versus the other. So that was part of this. The one thing, though, that you mentioned, which is very important, and which you're right, I neglected to look at, is that also not just the sign, not just the type, but also the size of the shock matters. A much larger shock leads to a faster response of inflation. And so when I came here and said, look, I can do 10%, let me multiply these by 4 a little bit, roughly that's what I did. Actually, you should, not 4, but really should have been 4.5 or 5, because a 40% increase in oil price
not linear.
wouldn't just multiply by 4, but it would be more than that. So absolutely correct. Again, I did this comes from the paper that does using some local linear projections. The nonlinearity is important in theory. Would it increase this number to? I know it increases this number. Would it increase it a huge amount or a small amount? I don't have the. I can't do it. I mean, what I've seen in the paper that you cited and others, there's quite a few others looking at the size dependence, is that I would need, if oil prices went not to $120 or $100 like they did from roughly $70 to $100, $110. If they went to 180, that's a whole different ballpark. You can't just multiply by 2 my numbers if you want. So it's not the case that if now oil prices, because of whatever happens, double and they go to 180, you should not multiply my impacts from 2% to 4%. No, it'll be 6% or 5% or something. So that's absolutely correct.
Okay. Thank you very much. If we have no more questions from the attendees, so I would like to thank you again for being with us, presenting us this fantastic paper and this captivating presentation. Again, the third time in the history of the virtual Israel macro meetings. So again, thank you very much for being with us this time, past times, and we hope future times with policy relevant papers. Thank you very much, Ricardo.
Thanks so much. Looking forward to the 4th.